So the purpose of this channel is to help you master your relationship with banks, make those relationships profitable, and leverage your relationships with banks to increase your net worth. In this particular video, we're going to be going over a quiet but powerful reset that just took place with Scott Bessent, and the current Trump administration is looking to overhaul 2008 regulations and unleash banks in a way that we haven't seen in decades. We're going to be covering who benefits from this, how it's going to impact us. Is this finally going to be a win for Main Street, or is it going to be another win for Wall Street? So these shifts, the reset that's going to be conducted by Scott Bessent, or the intention at least, is to roll back regulations that came out during the 2008 and after the 2008 crisis. For those of you who may not be completely familiar, in short, the 2008 crisis was a scenario where banks and insurance companies got extremely greedy, took exceptional levels of risk, crashed the real estate market, and nearly took down the entire global economy. Because of those behaviors, regulations were put in place to keep banks in check, basically. Scott Bessent and the current Trump administration want to roll those back in order to free up lending and increase the speed at which banks are able to move around and move money. Now, we need to talk about the important factors at play. How is this going to impact those who get access to credit? How is this going to impact your relationship with banks? And who's going to really benefit? So I got some notes here, and I'm also going to pull up this article for you. I'm not going to scroll as much through the article, but I do want you to kind of have a visual of what's going on here. So to explain in plain English what's going on with this reset, again, it's going to be a rolling back from the post-2008 financial regulations, right? Again, it's an intent to make sure that banks now will have the flexibility and the freedom they need to lend at a totally different capacity than they've been able to since 2008 and move at a different speed. And this is going to have a varying degrees of impact on not only the banks, small and large, but it's going to have an impact on our relationships as clients, as everyday working class people, as well as solopreneurs and small business owners. So this is going to be centralizing influence at the Treasury over regulators. So we're talking about the Fed, FDIC, and the OCC. These are going to be regulatory bodies that are now going to, if this goes into play, going to be under the watchful eye of the Treasury versus having autonomy as individual agencies. So this is going to be an emphasis of shifting from risk prevention to economic growth. They're basically throwing caution to the wind, and there's going to be some important implications that are going to impact your money and your ability to access capital, as well as your overall banking relationships. So banks are being encouraged to lend more, hold less capital, and move faster. That's basically what this boils down to. This is going to change banking behavior. So what does that mean? Deregulation, lower compliance costs, plus more balance sheet flexibility. Banks now have more capacity to lend, more room to price risk aggressively, and greater incentive to grow assets, loans, investments, and deposits. Some pros and cons to this. We'll get to that in a minute. But there's a catch. Banks don't lend more equally. They lend more to stronger relationships. That's going to be the challenge. For those of us that are not exercising our relationships with our banks, their ability to lend more, move faster, and flex underwriting is going to only benefit those who are already tied in and have great relationships. So this is going to be key for you to pay attention, because if you're not somebody who's tied in with your financial institutions and have a good relationship with them and banking effectively with them with a good internal score, then you can end up getting left behind at an exceptional speed due to these changes, okay? So impact on banking relationship and internal client scoring. This is what we need to really focus on as small business owners, W-2 workers, and those of us just looking to grow our wealth and increase our net worth. To be clear, we know banks internally score clients based on deposit balances, lending profitability, investment relationships, product depth, and risk profile. That's going to be some of the biggest mechanisms banks are gauging us by when they're scoring us internally to determine the quality of our relationship with them. So with deregulation, high score clients get first access to capital. The ones who check off those 5 markers I just gave you are going to be the ones that get access to capital first at the best rates and terms, which is going to allow them to move faster in the economy. Hopefully that makes sense. They're going to have better pricing, faster approvals, and larger credit lines. Those of us that don't check those 5 markers I gave you a second ago are not going to get these things. And it's going to push us behind those of us that don't meet the criteria and have a healthy internal banking score. So what does this mean for Main Street? Small businesses with strong relationships are going to win. Simple. If you have a small business or you're an entrepreneur, you having a healthy relationship with your bank, and again, meeting those 5 markers that I gave you, which is deposit balances, lending profitability, investment relationships, product depth, and risk profile, stuff like your credit report and credit score, etc., job stability, income stability. If you are not checking those 5 things off effectively, then these legislative changes by Scott Percent and the administration that's going to completely, do away with significant levels of regulations and allow banks to have a lot more autonomy in picking and choosing who they want to do business with, who they want to lend with, and who they want to pay better rates to, then you're going to end up left behind. So those without consolidated relationships are going to fall further behind, as I just stated. Key insights for you. Deregulation doesn't eliminate underwriting. It does not eliminate underwriting. Banks still do not want to lose money. Let's be clear. It magnifies who banks choose to bet on. Think about that for a second. Deregulation doesn't eliminate underwriting, but it magnifies who banks choose to bet on. So how is this going to impact community banks versus mega banks? This is also going to be important. The Treasury argues post-crisis rules entrenched big banks and suffocated community banks. Okay, that might be fair. Potential upsides: community banks regain flexibility. Less regulation, more flexibility for them. More local decision making, which is a powerful benefit for us as clients because they get to look at our personal picture versus putting us in cookie cutter boxes of a certain credit score, certain credit profiles, certain incomes, etc. Localized decision helps them look at your individualized picture and gauge you as a potential lower risk client by looking at their complete picture. The risk on the other side of this deregulation, mega banks still dominate capital markets with AI and crypto access. So big banks may be allowed to run amok, use their better access to technology and all the other infrastructure they have to run community banks and smaller banks out of the room, which could leave us with less options and could put us in a position where we're fighting in a much deeper pool of clients to get access to the banking resources and the lending resources we need to grow. Scale still wins unless policy is carefully balanced. So again, this basically means bigger banks could automatically dominate the market and push out a lot of small banks that are normally the ones that help us out the most and look at our individualized pictures the most if regulations tilt too far to deregulation. If regulations are abandoned at scale on an unhealthy level, this can lead to big banks trampling small community banks and pushing them out and other financial institutions that we're relying on in our communities to give us a shot when we don't qualify for bigger banks. So there's some concern there. There are wealth gap implications as well. This is an important segment. So hang with me on this for a second. Deregulation leads to cheaper credit only for top tier clients. The wealth gap can widen from this. What this basically means is, as I always say on this channel, I've been saying for years now, credit capital is speed. It allows you to execute in the economy at a faster pace. It allows you to pull income from the future to today's time and use it as leverage towards growth. Think about what I just said. Whenever you borrow money, you're essentially taking income from the future and pulling it to today's time. Your income is what's paying off the credit. So instead of you waiting to save that money and cash from your income, you're now pulling that income that you're expected to make from the future to the present and deploying it into economic activities like owning real estate, starting a business, etc. This is going to favor those who have top tier relationships with banks. And if big banks are free to roam free and use their scale and throw their weight around, this could push out a lot of smaller banks. putting those of us who don't have the best relationships with these banks at a massive disadvantage. Relationship-based access favors those already banked and invested, as I just alluded to. But if leveraged correctly, let me be fair on the other end. I don't want to make this into a scare tactic or anything to that, or a horror film. If you leverage this correctly, small businesses can expand faster. Minority-owned businesses can gain access if relationships are built early. If relationships are built early, banking education becomes more critical than ever, given these deregulations and the speed things can start to move at. So, deregulation doesn't create inequality. Unequal access to banking relationships does. Think about what I just said. Deregulation does not create inequality. Unequal access to banking relationships does. So here's what I'm going to recommend to close this out. Build multiple product banking relationships. Build a multi-product banking relationship. Do it with multiple institutions based on your financial means. Based on your financial means, okay? What I mean by that is if you make $2,000 a month and you only have about 300 of that left over, then you need to bank accordingly, okay? Don't go out and start 15 banking relationships spreading out $300. Please don't embarrass yourself like that. Set up a multi-product banking relationship with as many banks as you can afford to do so with, meaning that you can meet their minimum balance requirements, you can fund the accounts and keep them funded, you can exercise their various products and services. If that's only one bank, then do it with one bank. If you have the resources to do it with five, do it with five. That's number one. Consolidate deposits, lending, and investments where possible. So where it makes sense, consolidate with the banks that are going to give you the most value. If you're a small business, don't just shop rates. Build banker relationships. Oh my God. I can't emphasize this one enough. Do not get hung up on, oh, they're paying 0.25% higher over here. They're paying 0.5% higher over there. And you're running around with your money transactionally, having one night stands with banks. Meanwhile, you're getting locked out of the system because you're not building a rapport or a relationship with any of them. So you're unfamiliar to them and they don't want to lend to you. And you end up shot in the foot with no capital. Don't do that. If you're a consumer, so a W-2 worker or everyday person, your internal bank profile matters more than your credit score alone. Your internal bank profile matters more than your credit score by itself. AKA, do not think you can walk into a bank blindly and unfamiliar, walk in with an 800 credit score and get access to whatever you want immediately. That's not how that works. Your credit score is only going to be beneficial to you if you match it with a healthy banking relationship. I know this firsthand because I have many clients who unfortunately get denied for funding, get denied, access to other financial resources, and can't tear up their relationship at banks because they may have great personal financials, but they don't have any relationship with the bank that I work for, they're applying for. They don't have a relationship with them. Your 800 credit score doesn't mean anything because you're not familiar. Your credit score by itself is not going to get you infinite access to capital and the best rates and terms. It's not. You have to start becoming familiar to that financial institution and couple your great financial reputation with that familiarity to get the benefits of the banking relationship. My final closing thoughts. In a deregulated system, the people who understand how banks work will move faster. Everyone else will pay more. Say that one more time. In a deregulated system, the people who understand how banks work will move faster. Everyone else is just going to pay more for financial services, for access to capital. You're just going to pay more. So I hope this video brought tremendous value to you. I'm going to close it out. Comment down below. Comment reset down below and let me know what you think about this article and the coming changes to the banking system by this current administration and the deregulation to come. Let me know how you expect it to affect you and your finances, the concerns you have, and the opportunities you may see. Comment it down below. To all my pioneers, welcome back. To my new viewers, welcome in. I want you to like, comment, share, subscribe, support the channel so the channel can continue to support you. Get in the description section down below and tie in with me on Instagram. For those of you who are new and curious who you may be getting this information for, I'm JP, the founder of the channel. I am a career banker and financial services professional, 14 plus years in the field, actively managing a book of business of $25 million in client relationships between consumers and small businesses. I have a mortgage loan originator's license, small business certified, life insurance license, and FINRA investment license. I appreciate every one of y'all for tuning in. I want each of you to stay focused, stay in motion. I'll see y'all soon.